A Turkish expert has said that aggressive rate hikes by the U.S. Federal Reserve have a drastic effect on emerging markets, particularly import-reliant Türkiye floundering with a weak currency and runaway inflation. On September 22, the Fed decided on a third consecutive three-quarter-point rate hike, as it continues to ramp up its fight against the country's surging inflation. Most countries have raised interest rates to fight the economic impact of the Fed's rate hikes in order to protect their currencies and prevent the outflow of foreign funds. But Türkiye did just the opposite. It has lowered its policy rate by 700 basis points since September 2021 despite an inflation exceeding 80%.
It will, because Turkey has a huge international debt or foreign debt, which is about $450 billion. Of that, 182 billion will be renewed within a year. We call it the short-term debt. If the rates are going up, if the US dollar is getting stronger, that means Turkey can only borrow from international markets by paying higher interest rates, maybe 11–12% or so. So cost of borrowing in US dollar terms will increase. That will also increase the cost of doing business for the companies that have to borrow at higher interest rates. So it's going to impact Turkish economy in a negative way. But it will also affect Turkey's foreign trade, because most of our imports, about like 70% of our imports, are in US dollars. So it is going to be a really difficult time for Turkey to have a positive balance of payments figures in the next maybe year or two. It seems the Fed will continue to increase interest rates aggressively. Maybe during the next meeting it will be close to 100 basis points for Fed, which will translate into very high costs for countries like Turkey, who are dependent on international financial markets. When you decrease the interest rates, it affects inflation upward quickly. Turkish inflation is more than 80% at the present time. Last year, this time it was about 19.25%. What has changed since then? Main change we see is in the policy rates. They have lowered the interest rates and it pushed inflation up. People who have any savings started to buy euros, dollars, gold, or whatever. So it pushed the exchange rates up. As the exchange rates went up, it brought the inflation up as well, because the Turkish economy is very dependent on imported inputs, energy, raw materials,